Hi, it's Dre Griggs of Obsidian Wisdom. Today we'll answer the question, how do I plan for a wealthy retirement? Today we'll go over 4 steps that everyone needs to have a successful retirement. If you are planning for a retirement, then you'll want to have each of these steps included in your plan. I will share the one significant difference between a regular retirement plan and a wealthy retirement plan, what we do here at Obsidian Wisdom, and we'll do it in a simple and clear way where we don't feel overwhelmed or confused. Most of the time, people don't make decisions with their money. If you ask me, it's twofold. One is they're not 100% sure what to do with their money. And two is they feel a little overwhelmed, like nobody wants to lose our money. There are tons of studies that talk about the feeling we get when we gain or lose something. And the majority of the time for us, the feeling of loss is much more painful than the joy of winning something. And when it comes to retirement planning and investing, we're so concerned about losing our money that we don't take any action whatsoever. And so the first step is your retirement readiness. You need to assess your financial situation. How much money do you make? How much money do you spend? And what assets or liabilities do you have? Long term, short term? Where is the money going? How is it being allocated each month? So for most people, we're not comfortable understanding where our money is going each month. We don't have peace of mind. We worry about the money. Do I have enough? And as a result, sometimes we spend a lot less than we would have spent in retirement if we had the confidence. The first step of having a wealthy retirement plan or any retirement plan is you need to be confident in the numbers. Take a quick assessment of how much you spend each month currently. This is your current situation. How much do I spend each month on food and traveling or gas and insurance? Just how much money do I spend each month? Where does that money go? Just take a look at your previous month's spending and then just put them in categories and take rough estimates. You just want to have a general feel of where your money is going each month. Then you take how much you make each month and all of your income sources. Do you make money from a business, your salary? Do you have passive income? You want to take an inventory of all the money that you have. And then, as I mentioned, when it comes to your assets, these are income producing assets. For most people, that's going to be real estate, a business, or stock investing, right? For most people, that's going to be the 3 ways that generate an income when you're not talking about just your earned income, your salary for working. And then when it comes to liabilities, what debts do you currently have? We're not talking about, I'm going to pay this off, it's going to be gone. Just assessing our current financial situation. What debts do you currently have? Do you have a credit card debt or a mortgage payment, or do you have money going towards auto payments? And once you have an accurate understanding of your current financial situation, then you're ready to move on to step 2 of planning for your retirement. And that is your retirement goals. You guys know that I'm big on setting goals, and the reason is very straightforward. So there's 2 benefits of setting goals. One is I'm able to remind you of your goals where we have this barometer. This is what we said we are going to accomplish. Are we taking steps towards that goal, or are we taking steps away from that goal? And just by having that reset, that flag that's planted out on whatever your dream retirement is, you're able to then say, okay, I'm actually moving away from our goal. I need to turn back around, which gives you the unexpected benefit of being able to say no to a lot more stuff. Because I find that most of the time when we're making these short-term decisions, it's because we don't feel like there was much else to do with the money. We don't have any other goals that are set aside. So I set a new goal. I want to get a Lamborghini or something like that. But if you have this long-term goal where it's a very clear picture that you paint, and you often hear me say that you should write out about 50 goals. And I know you guys are always like, Dre, come on, 50, that would take a long time. But truth be told, it's because your first 10 to 20 goals are really just the things that are bothering you the most right now. And they don't really actually move the needle. Like if you actually had enough money to get rid of all of those squeaky wheels, then you would be sitting there and you'd be looking around like, I don't know what to do with my time now, Dre. But the good thing is we can then flip to the next page and we have 30 more goals that really would move the needle. Things that we can look at and say, that is very important to me, Drake. That is so important to me that I'm willing to forego something this year. Not in the sense that I'm sacrificing my joy and satisfaction, but in the true sense of the word sacrifice, where I'm giving up something that has a lesser value to get something of a greater value. And you have to have goals to be able to do that. Next, you need to figure out how much it would cost for you to have this dream retirement. When people make retirement plans, they usually have one of the two. They either have the dream retirement where they're sitting on the beach and life is great, or they're traveling, or they're doing all these amazing things. Or two, they know exactly how much money they need in retirement based on the expenses that they believe they'll have. But most people don't have both of them. You want to have both of them. You don't want to just set your retirement solely based on this is the debt I have now. I need to be able to pay my bills, because that just sounds like you're just waiting to die. That's not what retirement is supposed to be at whatever age you decide to retire. We really want to have a retirement that is set up because it has this amazing list of things we're going to do with our life that will help us feel fulfilled and satisfied and happy, where we'll be able to provide significance and benefits to our friends and family and people that we appreciate. We'll also be able to be very satisfied with how we live our life, how we spend our time. You guys know I'm a big proponent of happiness. And the biggest thing I find as far as measuring happiness is what you do with your time and your money. Those are the two currencies that you get to trade to create whatever life you want. Let me just take a second to say thanks for watching the video. You could have been watching anything. You chose to be here with me, and I do not take that for granted. If you find value in this video, go ahead and like and subscribe so you can continue receiving valuable insights on how to solve generational wealth through wealthy retirement planning. You have time and money. If you spend a lot of time doing things that bring you happiness and joy with the people that you love and appreciate the most, I find those people are very happy. If you have someone that's able to spend their money on things that bring them value and satisfaction and support causes that they believe in, I find that those people are very happy. So you need to know what I want to do in my dream retirement. So that's how you allocate your time. And then you need to know how much does it cost for me to be able to do that? How much does it cost for me to spend time with those people, to travel to those places, to support those causes and charities that I believe in? And then you put that together. And the very final thing that you need as far as setting your retirement goals is, what is the timeline? How many years out am I going to wait before I retire? Because you really have three levers when it comes to your retirement. You have how much money you can make, how much money you can spend, and how much time you have. And so if you want to retire in 5 years, then we have to put a plan together where you invest probably a little bit more money than you would if you want to retire in 10 years. But then if you want to retire in 20 years, you can invest a lot less money. But then based on the goal and the lifestyle that you have, maybe we need to invest more. Or if you're able to get rid of some of this debt, then maybe we can invest less. Those are the three levers that you always get to control: how much money I'm going to make, how much money I'm going to spend, and how long I'm going to wait. And then that moves you into the third step of creating a retirement savings plan. Where am I going to put the money? So I already know that there's a certain amount of money that I need to invest every single month to fund my dream retirement. I already know what my expenses are going to be. I know exactly what I'm going to do. So where am I going to put the money? For most of you, a great place to start is normally going to be in your 401k, 403b, your pension, things like that. Wherever the money is, where your company is going to match it. When you get the free money, most people, that just makes sense for you. If you can start out by saying, okay, if I put 5% in and then the company puts in 5%, I automatically already have 100% return on my money. This is a great place to start. Now, the reason I rarely tell people automatically without really sitting down and going over the information with you to invest more than whatever the match is because the fees associated with the majority of 401ks is really expensive, especially when you take things into consideration like target date funds, which is a very fancy way of saying they just allocate the money differently as you get older, where they're moving your money from stocks or riskier investment into slightly safer and more conservative investment as you get closer to retirement. Do I think that that's something that you could do yourself? Of course I do. Do I think that that's something that even a financial planner could do, where the fee would be significantly lower than having it bundled inside of your 401k? Definitely. But because most people aren't sure what to do with their money, they feel a little bit of comfort knowing that it's just to set it and forget it. And even though I'm paying probably more than I should be paying for this service, I just feel better being able to set it and forget it, which I understand that peace of mind is something we all want to achieve. But I often tell people peace of mind does have a cost. It does have a price, and you don't want to just pay an infinite amount. Like, how much should your peace of mind cost? I don't know. But what I will say is the more you know, the more wisdom that you gain about investing in the industry as a whole, the more comfort you'll have and the more peace of mind that you'll have overall with your own investment. The less you know about investing, the lower the amount of confidence that you're going to have. And that's normal. Sometimes our body is telling us, hey, I'm not confident. And it's the truth. We're not confident because we shouldn't be. Right? If I talk to my kids about taking a test and they're like, how do you feel about it? Well, I don't feel very good. Well, did you study is going to be my first question. And then they'll say yes or no. And if they did study, I'll say you should be confident in the process. And you're probably feeling excitement because excitement and nervousness feels the same way. And then they'll be like, oh, Dad, you always say that. And I do always say that. But if you say I didn't study, then I'll say, okay, well, then your body's trying to tell you something that you should probably study so that you can build that confidence in the test. And that's really the same way I look at investing. So for most people, it's very important that you diversify your assets. Now, it is true that if you have a solid understanding of certain investments, that you don't need to diversify. You can invest in that one company, that one fund, and get the returns that you would expect. The reality is most people don't have that sort of comfort to be able to invest in one particular asset. And because of that, diversifying is normally a way to limit the risk, where you're not all in, where you may gain 100%, but you may lose everything as well. But instead, you have an asset allocation where you have some stocks, you have some bonds, you have some real estate, you have some long-term, short-term investments, where you put a nice portfolio together, almost like a bouquet, where you have a little bit of this, a little bit of that. Some perform well in this market, some perform better in that market. And then you have a relatively steady investment experience, which I find most people need for them to be able to consistently invest. Because the day that you lose 30% of your portfolio, for a lot of people, that's the day that you leave. And that's why when it comes to hedge funds and other sophisticated investments, that's often why you have to be an accredited investor, where you have to be someone that has a certain amount of income, a certain net worth, or a certain investment experience and understanding, because otherwise you'll probably lose your money. And that's true for most people. So that's why I often tell people you want to diversify your investment. And the good news is there are studies that say up to 90% of your portfolio's return is based on the asset allocations that you choose. And so for most people, that is a great place to be able to start. And I'll put a link to another video where I talk about if I wanted to have $100,000 a year in retirement, what would that look like? And then I go through the 6 income streams, their average return, and how much money you would need to have invested. But it's very good for most people when it comes to building a retirement to be diversified in multiple assets, unless you specialize in something. And as we mentioned, where you have a specific set of knowledge, where you have a wisdom. And as you know, wisdom means insight. And sometimes it could be translated as skill, but wisdom means insight. You have this experience, this understanding, these life experiences where you're able to say, I know exactly what to do in this situation. And if you have that, then it's a great way for you to diversify your income. And once you have chosen your assets and know how much you're going to invest each month, you then need to just set a cadence where you review your investments and adjust periodically. There's going to be times that your real estate portfolio may be outperforming the stock market, or the stock market may be outperforming your business, or your business may be 10x in the last 12 months, where you're looking at your income and you want to be able to diversify it, where you need to look at some of these income streams and decide whether you want to keep investing in this diversified portfolio, or whether you feel like you built the skills and the knowledge to where you feel very comfortable investing in any one of those streams, where you say, you know what, Dre, I'm really understanding my business. I feel really good about it. It's very comfortable. I know that I can get another 10x. Well, if you're that confident, then it may make sense for you to go ahead and say, all right, I'm not going to buy real estate now, and I'm going to put that real estate portion of my portfolio inside of the business. And then you just build your portfolio from there. Now, for others of you, you may say, you know what, I'm just going to stick to the plan. I already know what my numbers are. And I know if I follow this plan, I'm going to achieve my retirement goals, which is fine as well. And in that case, what you'll do is you'll take some of the profits from the business and then you'll reinvest that in the real estate. So that way you can balance your portfolio back out. And I'll put like a chart where it just kind of shows you that, where I think I show an assets where something is going down because for whatever reason, the market isn't doing good for one of your asset classes, and then something is going up. And what you'll do is you would sell that portion of the profits and then you'd invest it in the portion that's going lower. And then you're able to rebalance your portfolio. For other people, depending on how close you are to retirement, you're going to need to make those adjustments anyways, where maybe you say, you know what, I'm going to retire in 5 years. So I need to have an allocation that makes sense for someone who's going to retire in 5 years, versus the allocation that you had when you were 15 years out from retirement, where you're very aggressive because you felt like you had a lot of time to make the money back, which is obviously a very reasonable expectation. But as you get closer to retirement, let's say you're going to retire in 2012 and it's 2007 and the market is going gangbusters. You have these amazing returns, but because you're 5 years out, you should have started adjusting your overall portfolios to match the risk that you had for someone who's going to want their money in 5 years. That's different than when you started maybe 20 years before that. Well, most people didn't make that adjustment. And so as a result, they ended up losing on average about 60% of their portfolio in the stock market when the Great Recession happened. And because you didn't have the same amount of runway, at least initially, you did not see those returns come back. Now, granted, if you were able to say, all right, well, look, it didn't work out, I'm going to work another 10 years. Well, then you made all that back and then some, as long as you stayed in the stock market invested. But for a lot of people, a lot of households, there's charts out there that show that the amount of money that the average household invested dropped significantly after the Great Recession. So what does that mean? That means that they sold at the absolute bottom and then they were done, which is really unfortunate. But that leads us very nicely in the step 4, where you want to consider other retirement income sources. Now, this could be Social Security, where you're saying, look, Dre, I think Social Security is going to be here. This is what I put in. And you go to the Social Security website and you can simply see what is an estimate of how much you should get based off of your Social Security credits. And then they'll say, look, based off what you have, you should get $1,500, $3,500 a month, whatever it is. On average, it's about $1,700 a month. That's what the average Social Security payout was in 2023. You may consider working part-time, where you're like, you know what, Dre, I'm a little bored. Like I thought I wanted to start working, but I just wanted to start working there at that particular place. I actually like interacting with people. I like working, and maybe I'll find something that brings me passion. You could also start a business. And I mention that to you all the time, that there are people that tie their business and their passions together. And I find that that gives you the ability to endure some of those early struggles of starting a business, because if you really think about it, every single step of our life, where you were born, you went to school and TV and things like that, it's always from the perspective of being an employee or a consumer. And it's rarely from the perspective of being a producer and an owner. And by owner, you can actually start the business or you can invest in someone else's business. Either way, society doesn't generally teach us how to do that. And as a result, I would say that that's probably one of the largest reasons that most businesses fail. I know we talk about the fact that you don't have the funding, but there's so much money out there. So why wouldn't we have the funding? The reality is, it's the mindset, it's the beliefs, it's the expectations that were put upon us, whether it was in school or our parents trying to figure things out. And as a result, we end up self sabotaging where we have to get over that hurdle. Now, is retirement the best place to do that? Well, I don't know. If you have the time and the money, then why not? You're here, you might as well enjoy yourself. But because of the difficulties that most of us will face reprogramming our understanding of money, that is why I find that if you're able to tie a passion with a business, you can often endure some of those early headaches as you figure things out, as you reprogram yourself, as you shift your mindset and your understanding to be able to generate additional income.